Hey guys, welcome to another episode with me, Shashank Udupa. And in this episode, we're going to talk about something very different, and that is known as momentum investing. Now, I'm not sure if you guys have heard of what momentum investing is. It is slightly different from the regular investing strategies. But don't worry, we're going to clear that doubt as well today. So, in this episode, we're going to talk about what momentum investing is, okay? How to build your own momentum investing strategy. What are the different stats with relation to momentum investing, whether it's good or bad. We'll look at some of the stats as well. And finally, we'll look at what are the negative effects of momentum investing as well. This is only for educational purposes, so you understand when someone talks about momentum investing, you'll be like, yes, I know this because I saw this on the Grow video, so I have exactly full idea of what this is. So we're going to do that in the next segment. What is momentum investing? Okay, so guys, now we know for a traditional element, right, when you're investing in something, we always look at, okay, you need to buy low and sell it when it's high. So you make that profit, right? That is what normal investing is. But this is where momentum investing is slightly different. So momentum investing, as the name suggests, is basically depends on the momentum of a stock price. So it is not encouraged by buying low and selling high, or it is not discouraged by anything else. Basically, what this idea means, what momentum investing is, that if a stock is in an upward momentum, okay, if the stock price is rising slowly and you feel that it is in an upward momentum because maybe it is trending, maybe the commodity cycle has just kicked in, so maybe say for example, all agriculture stocks will go up, so the momentum of those stocks will be going upwards. So when that happens, right, when you understand that the momentum of a particular stock is towards the upward directions, that is when investors come in and buy these momentum stocks only until the momentum lasts. Right, so it's considered like trending stocks, right? So if there's a momentum in the stocks for an upward movement, you buy and you sell once the momentum is over. Again, you have no idea when the momentum might get over, but you predict that, okay, this entire industry, for example, recently we saw that our entire metal industry was doing well. So the momentum of the metal industry stocks were on an upward journey. Now it has died down a little bit. Now the metal stocks are not so much into limelight. But whoever played with that momentum of metal from start of the metal journey to the end of the metal momentum, they would have made money. Same thing happened last year. If you remember when COVID happened, pharma stocks were in momentum. All the people who played on the pharma stocks, bought them and sold them towards the momentum, they made money. So basically, no one's looking at any kind of fundamentals here. There is no fundamental analysis. There is not much of technical analysis. The most analysis that they do is whether this momentum of this industry is currently trending or not. And if it is, they buy it and then it goes up for an upward direction and then sell it at a higher price. Okay, now that is one. But there's another way to do this as well. The other way is reverse. Okay, assume there's some kind of a bad news. Okay, government changed some new GST tax slabs and, some type of industry, maybe say for example, paper industry came with a higher tax slab. You and me both know that the entire paper industry will start declining on a downward trend. So what a lot of people do, they even catch negative momentums, right? So they actually short sell the stocks. Okay, when it's going down constantly, they sell it first and then they buy it at a lower price, thus making the profit there. So momentum does not always have to be up. Okay, it can also be down. It can be upwards and it can be downwards as well. Now let's see how you can build a momentum strategy in the next segment. Okay, now in this segment, let's figure out how you can build your own momentum strategy. Now let's look at this. There are a lot of ways to build your own momentum strategy, but we're going to refer to a book which was written by Jack Bogle and Wesley Gray, and it was called Quantitative Momentum. And let me tell you some of the interesting things that they figured out in this book that might help you build your momentum strategy. Now, in this study, in the whole book that they gave out, there were 3 types of momentum stocks, okay, or 3 types of momentum, not stocks, but 3 types of momentum. And what were they? Okay, one was short-term momentum, which was basically returns analyzed for a particular stock over a period of 1 month. Okay, short term. Then there is long term, returns analyzed over a period of 5 years or 60 months. And then there is medium term, returns analyzed over a period of 6 to 12 months. So 3 types of momentum strategies are there. Now, when they did this analysis, both Jack Bogle and Wesley Gray found out that long term, okay, which was the 5 years, long term momentum, and short term, which was 1 month, can lead to reversal of gains. Okay, for example, what is reversal? Return reversal means basically if I invest in something and I'm waiting for that momentum to pick up for the next 5 years, the chances of that, just reversing the trend, whether it's going up, suddenly it'll go down, or if it's going down, suddenly it'll go up. The possibility of that is high in long term, and the possibility of that is there in the short term, which is less than 1 month as well, because it can tend to be volatile. So that is what they said. But interestingly, the medium term that we spoke about, which was 6 to 12 months. So what they've said is that medium term actually exhibits a continuation of returns. That means, for example, what they've found out from that book is if that the 6 months, the medium return momentum stocks, if it is consistently doing well over a period of time, that means it will continue to do well over a period of future time as well. And same way, if it is continuously doing bad, like if it's performing poorly, it will continue to perform poorly as well. That is what medium term stocks look like. So 6 months to 12 months ka jo range hai, in that range, if it's constantly going in an upward direction, then for 6 to 12 months, it will go in an upward direction, or it might go in the downward direction as well. But now, it is not that simple. Okay, you might be like, no, but Shashank, nobody can predict the market. There might be a possibility where it can go down also. Yes, I completely agree. So this is why you cannot bet on continuation. Okay, if you're telling me that this will continue to go up all the time, that is not the case. Now, what you should do at this point, right? What you should do at this point, you should keep tracking those momentum stocks on a monthly basis. Every 1 month, every three months, you should see how the returns are playing. Now, both Jack Bogle and Wesley Gray actually predicted that for a shorter holding period, the portfolio that you have has to be constantly rebalanced. So rebalancing is basically the process where the investor, okay, restores the portfolio as it's for its target allocation. Just tries to amend it so that there's no heavy weightage on a particular stock. What happens is, while practicing momentum like this, if you're trying to do a momentum strategy or if you're building your own momentum strategy, one thing you need to realize is you can't over diversify. Okay, you need to have a smaller concentration of stocks. Don't have 20, 30 stocks in the portfolio because you will not be able to get the true value or true gain of the momentum. So ideally, you should have a concentrated portfolio. And by that, I mean you should have less stocks in your portfolio, not too many stocks. And if you have less stocks in a portfolio than a diversified one, you can adjust the returns in a proper way and keep rebalancing it all the time. Now, there is another thing that comes when you're building your momentum strategy. And this is something called as price path. Now, what is a price path? Now, the price path of a company should be smooth to ensure that this might do well over a period of time. For example, if a stock over the last 6 months is slowly going in an upward trend, the possibility of it going in an upward trend is slightly higher than a stock that has been going up and down, up and down, up and down. You cannot predict where this is going to go. Right? They call it like a lottery stocks because it's so volatile. It might suddenly go up one day, suddenly come down 5%, go up 15%, come down 20%. You cannot predict where the momentum of this stock is. But if I am looking at a stock that is constantly on the upward journey, then I can predict that the momentum of this looks like it is going to go upward itself unless something comes and changes that momentum. And when that happens, I quickly rebalance my portfolio and come back to a very good point. So tend to stay away from very volatile stocks. Volatile stocks means up, down, up, down. Try to stay with a clear path stocks. The path of that stock before buying your momentum should be a smooth path, right? Either upwards or either downwards. It doesn't matter. Because in momentum, it only depends on whether you're going upwards or going downwards. So that is how you build your momentum strategy. A smaller portfolio, rebalance it constantly, look at the past, whether it is an upward trend or a downward trend, and focus on rebalancing it more so your CAGR becomes better. Now let's look at whether it actually works. Okay, you're like, Shashank, okay, you're talking about momentum investing, momentum strategy, but show me some data whether it actually works. Now, does momentum strategy really work? Let's look at some historical data. So according to the book, Jack Bogle and Wesley Gray, what they did was they applied their momentum strategy on the US large cap and mid cap stocks from the year 1927 to the year 2014, approximately over a period of time of 87 years, and studied how the returns would look on a monthly basis. Okay, so I'm going to show you some image here. Just look at this. Now, if you look at from a CAGR perspective, CAGR is basically compounded annual growth rate. Momentum strategy gave a CAGR of 15.8%, beating the S&P 500 index by 9.92%. So S&P index was 9.92 and momentum was around 15. So it beat it by approximately 6 to 7% extra, right? 6% extra. Now, if you look at standard deviation is basically the general volatility of the portfolio. Matlab kitna upar, how up and down it will go. That is what standard deviation talks about. Momentum strategy, if you look at the deviation, it's higher than the S&P index. It is at 23.89%, whereas S&P is slightly lower by 19.1. That means the S&P index is less volatile than the momentum strategy. What is downside deviation? Downside deviation, matlab how much your stock can deviate towards the lower end, matlab in a loss perspective. So if you look at momentum strategy, it basically talks about 17.56 was the momentum strategy's downside deviation, and S&P 500 index had 14.22. And look at the best month returns. Momentum strategy had 31% in its best month and S&P had 41% in its best month. So there S&P was slightly better. If you look at the worst month they had minus 31.91% in momentum strategy and minus 28% in S&P. Again, S&P was better in the worst month and best month returns. But if you look at profitable months, momentum strategy had a 63% rate and S&P 500 index had a 61% rate. But on a CAGR perspective, compounded annual growth rate, obviously momentum strategy did much better because it had 15.8%. This was the stats, but I want you to understand what causes a momentum effect. Okay, what is this momentum strategy and what is this momentum? What causes this momentum and why is it happening in the stock market? Now I'll tell you why it happens in the stock market. Usually in value investing, what we do is we buy low, sell high, and that is done, right? Because what happens is, usually I'll tell you, when we buy low and sell high, whenever there is a bad news in the stock market, people in the stock market overreact to bad news. Okay, whenever there's a stock market bad news, they're like, oh my God, crash bubble, everything's going to fall down. And you see that the stock, which is a good stock, maybe a fundamentally good stock, when there's a bad news, it comes down quite significantly. So that is what usually happens when it's a bad news. But the same thing if you look at reverse. Right? If there is a good news, it usually does not go up so fast like how bad news. So people usually overreact to bad news in the stock market and they underreact to good news when it comes to the stock market. A second thing that we have observed, okay, a second explanation that is there for this momentum is also known as timing. Now, investors usually react slow to new information. Okay, if any new information has come out today, first we need to process it, we need to understand it, then find out the implications of that, and then see which stocks will it affect, and then how will it affect each stocks, and then how much it has to go up or go down. So what happens is, you see this time period is there, right? There's a few days, few months for this time period to understand, oh my God, this commodity prices are going to go up. Yesterday I saw a news where it said because the commodity prices have gone up, your applications at home, like your fridge, AC, TV, all of that is going up because the raw materials inside is going to be expensive as well. So now those stocks are going to do well, but we never knew about that before. So slowly it takes time. So that is the reason why these are the two causes why momentum comes in, right? Because investors are a little slow to react to news and see how this news actually works in their favor. Got it? Awesome. So in the next segment, it's a small segment. Let's look at what are the drawbacks of momentum investing. Why is it bad? Okay, so let's look at that from that perspective as well. Now let's look at the drawbacks of momentum investing. What are the negatives here? Okay, so from what we observed in this entire episode, we also realized that, in momentum investing, because it's all on the momentum, it tends to be volatile because the momentum might change also in the future. So volatile basically means it goes up and down very fast. So obviously when it's a volatile thing, it becomes very risky compared to other investing strategies like value investing, which is buy low, sell high, and forget about it for a long period of time. These strategies sometimes can underperform for years at a time, right? It can underperform the market because it is very difficult to catch the momentum at a particular time and exit at the right potential as well before the momentum turns, right? Because if it goes up too much and it starts correcting and you have not exited, that's a big issue for your momentum stocks. Number one. Last thing over here that I've noticed is that in momentum strategies, they usually tend to be more expensive in terms of trading costs. Why? Because remember we said that every 1 to 3 months you have to keep rebalancing, keep buying and selling, keep adjusting. So when you keep doing short-term buying and selling trades, you have to pay brokerage costs and you might incur STCG as well, which is short-term capital gains tax as well. Even though the CAGR is good, you need to understand from your perspective that is this a good way or is this a good strategy to employ, and is this something that we can do, because you need to get significant returns and beat the market in a very high way, right, compared to what you would do it in a value investing. If value investing you're getting a certain percentage, momentum has to give you more because you're incurring trading cost also, so it's very expensive as compared to your buy and hold strategy. Okay guys, so this was the entire video on momentum investing and I'm just going to sum it up. I hope you understood a lot. I hope you learned a lot. Basically, we first figured out what momentum investing was. Then we understood how to build your own strategy and the 3 types of momentum that were actually there. Then we looked at some of the data with respect to how it was worked out in US. Again, you can look at a lot of information that is there for India as well with respect to momentum investing. We looked at what causes these momentum investing trends to happen, and then we also looked at the negative things, right? So the main reason for doing such videos is only for knowledge, so that you understand what momentum investing is. But wait, not only the good things, you should also know what the bad things are, so that you can take an informed decision as an informed investor and an educated investor, because in this market, educated investor beats any kind of investor. Okay, so I hope this helped. I hope you like this video. If you do, please below like, down, subscribe, everything, and also share it with your friends as well. Okay, awesome. See you guys later. Bye. Shashank Gurpa signing off. Hey guys, just a disclaimer: any stocks or funds in this video, mentioned in this video, are not a recommendation from me or our team. This is only for educational purposes, and that's it.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.